All right. So what we're going to do in this class is kind of further refine some of that with some of the details in these markets as they pertain to finance. So we're kind of diving in a little bit deeper with this course. And so Chapter 6 gets into greater detail on interest rates of various types of bonds. So when we started it off with the way we approached it in money and banking, we had one interest rate, or it's not uncommon in econ class in general to look at just one interest rate. And here, this picture shows us how that's okay for kind of general movements of the economy. Interest rates tend to move together. So over time, long-term and short-term interest rates, corporate bonds and government bonds kind of tend to move together. So in that sense, for some applications, it's okay to think about a single interest rate, like we've done in some of those markets where we just have supply, demand, and the interest rate, because this is a little bit reassuring that at least they kind of tend to move together with all types of financial instruments. So what we're going to look at here is why some of these financial instruments have differential rates. Okay, so we've got three reasons why bonds of similar quality, by the way, not too different quality in terms of the things we're going to look at, but there's slight differences in three different areas. So bonds with the same maturity, different due to liquidity, and 3, tax considerations. So what is default risk? How would you characterize default risk? Okay, they're going to go belly up and just not make their payments at all, right? So what is the chance that they're just not going to pay? So default risk, and I like that you threw the probability, the chance, the probability that the debtor will not pay for whatever reason. If they truly go bankrupt, belly up, or just get restructured or are slow to pay. Probability of default. The U.S. government has defaulted how many times? The federal government, how many times have they defaulted on their bonds in history? Just kind of looking back at the last couple hundred years of U.S. history. How many defaults has the U.S. government had?
0.
That's 0. That's right. So our probability is 0. Now, just because historically something's been 0, is it right to make a prediction that in the future it'll be 0? What do you think? Absolutely not. Yeah, it's probably a good way to look at, in theory, but that's the false thing that a lot of people do, right? They're like, oh, well, over history, this let's get back to your retirement fund. This fund has done 10% of stocks. Some years were 12, some years were 8. But on average, over the last 10 years, I was earning 10% with this stock, this particular investment. which means I'm safe in saying that I'm going to earn 10% for the next 2, 3, 4 years. That's the logic that people use, right? We kind of look backward, and then if we simply make our predictions on what the previous history was, what are we missing out on? What does that miss out on? Sometimes, by the way, for very short predictions, that method might be okay to say, you know, the last 10 years it's done 10%, what's it going to do this next quarter? And it might be pretty reasonable to say that it's varied from 8 to 12%, and right now it's at 11%. What is it going to be next quarter? It might be pretty safe to make a prediction that it's going to be within that band, right? Or the next 2 quarters, maybe even the next year. But if we start to make that linear prediction out much further than that, we can run into problems. Why? Why is looking at history only not, and the performance not a very good idea? Okay, so the underlying fundamentals of what drove that return changes, right? That's the real driving force. It's not just the return, but it's what was going on. So during that time, if we're getting back to a company, what was it like in the economy? Was the economy good? Was it solid? Was it soft? What other external circumstances? Was there a CEO in place? What other factors were contributing to that company at the time that they performed at the 12% level? Those underlying fundamentals is what really drove the 10% rate of return. And so if those underlying fundamentals are not there in the next couple time periods, there's less reason to believe that they'll still perform at that level. Or if a terrorist attack or some other external circumstances that are not internal to the firm, if something external happens, that can also screw things up. So economists like to have models that are predicting the movements of those underlying fundamentals to get a better prediction of the future. And of course, as we know, they're not perfect at it. All right, so back to the US government. Why else might it be reasonable then, since in general it's not reasonable to predict that they would never default, or that companies in general, that's kind of a stupid thing to do. Just because it was 0 for the last 200 years doesn't necessarily mean it's going to be 0 moving forward. But what's special about the US government that's maybe different than private companies or other sorts of places we might invest our money?
They're also tax-free.
What's that?
They're also either tax-free or there's tax-free.
No, not with the federal government bonds. There's taxes with them. Taxes on the return. We will come back to that with municipal bonds, is where there's some tax benefit. What can the government do? So it's the probability of defaulting on the payment. So if there's a $1,000 bond and the government, Obama, owes you $100, why is it reasonable to think that the federal government might be able to pay that $100, even if things are looking kind of sucky? What can the federal government do that corporations like GM and other places can't do? Issue money, print off money, right? That's a pretty special thing that they can do. What else can they do? So printing off money is a huge thing. They can just run the printing press and pay off their debt. They can do a little bit of internal borrowing. There's probably a little more flexibility. Who pays for that movement of the borrowing ultimately, though? What is the government? How do they make their money? Taxes. So they can force taxation. Chrysler cannot force you to buy their car, but the government can force you to give them money. Otherwise, they throw you in jail. Right? That's what they got the Internal Revenue Service for. So it's an involuntary system with taxation. So they got 2 chips going for them. 1, they can print off money and just pay for it. 2, they can raise taxes and force payment, force enough money to be collected to pay it. So for those reasons, we treat the US government stuff as default-free or risk-free in terms of this default premium. And so it's generally referred to as the risk-free rate. All right, so the risk-free, let me do it down here. So what we're starting to think about is what we refer to as the risk premium. And the risk premium is the spread between the interest rate on bonds with default risk and interest rates with the same maturity. We're going to hold that constant. So if we got a corporate bond of 3 years versus the U.S. government of 3 years, and the interest rates on treasury bonds. So the treasury bonds, we're saying no default risk due to 1, printing money, and 2, increase in taxes. Otherwise, these other corporations, with the chance of default, if you're going to take on that GM corporate bond, then there's a chance of default. We compare that to the government, and that extra amount that you're getting, if the government's paying you 3% and GM is giving you 5%, that 2% is the risk premium. The premium you're getting for taking on additional risk, that risk being the default risk. All right, questions or comments there? So what was the bond market all about? What was the things? We've got to kind of dust off the cobwebs. For some of you, those cobwebs are thicker than other people. What was the bond market? Back to kind of a supply and demand analysis. Okay, and yeah, we had loanable funds, and when we're in the bond market, it was the quantity of bonds being those loanable funds. So loanable funds in general is kind of that more abstract, take a step back and think about the big picture of the loanable funds market with the single interest rate. Now we're going to be taking a step inward a little bit and looking more at the detail. So here we might have the quantity of corporate bonds. So, supply of bonds, demand for bonds. We've got corporate bonds of similar risk. And what's going on the vertical axis? The price. Good. So the price of bonds, not the interest rate. By the way, you can model it with the interest rate, but when we looked at the bond market, we simply put the price of the corporate bonds here, which I'm trying to stay consistent with your textbook. PC for the price of corporate bonds. And so we had PC1 as the equilibrium price and quantity of corporate bonds under the current market conditions. Okay, so just for a little bit of review to get those cobwebs dusted off again. By the way, this is all in, even those of you who didn't use this book, just the previous chapter to this. I think it was chapter 5 and maybe chapter 4. All of the elements of a bond are discussed. Yeah, right in chapter, I guess it's 4 and 5. What were those bond elements? So Obama says, I owe you, love Obama. What were the elements on this piece of paper we call a bond? That little instrument, that financial instrument that we call a bond, that was simply just an IOU, what were the pieces of the puzzle that we had to think about when we talked about the bond market? Face value. Good. What's face? What is the face value in general? What does it mean in relationship to the bond? Okay, the redeemable amount at the end of the bond, right? So if this bond, this piece of paper, kind of similar to our currency, if this bond says $1,000, then Obama promises you promises to pay you back the holder of this instrument, because it can be transferred in the bond market. If this is a 5-year bond, it can be traded all day long on Wall Street, right? Whoever's the final one holding the piece of paper, Obama cuts a check for $1,000, the face value of the bond. Okay? What else were the elements? The maturity date. Good. So we had the maturity, which can run in all kinds of lengths of time. So the government issues out these IOUs in all kinds of lengths. The short ones, the T-bills, when we talk about treasury certificates, it's usually referred to as less than a year. So 3 months, 6 months, something less than a year in general when we use the word T-bills, treasury bills or treasury certificates. All right, so the maturity is the length of time that it's going to take to get to maturity. What else we got? The what? Coupon. Good. And what's the coupon? Okay, the amount of a payment that you get over time. Do all bonds have coupons? What do we call them if they don't? Zero coupon bonds, right. So then you just have the face value. This bond might have sold for $900 today, and 1 year from now, Obama's going to pay you $1,000. There's no coupon, there's no interest payment, no coupon payment in between. So that'd be a zero coupon bond. So they don't have to have a coupon. It could be zero. But otherwise, if the coupon payment's, let's say, $100, then each time period over the course of 5 years, if this has a 5-year maturity, the government's going to kick out $100 each time period, plus at the end of the term give you $1,000. That's the deal. That's how it's structured. Okay? All right. Let's see. Anything else we're missing from that? Just, I guess, to bring up interest rates. So what is the difference between the interest rate and the coupon rate? And why do they differ? So the coupon rate, what's the coupon rate on this bond that I have drawn on the board? 10%, right? So it is determined by the initial offering by Obama. He said $100 for the next 5 years on $1,000. 100 divided by 1,000 is 10%. So the coupon rate's 10%. The interest rate might be different. Why? Cadence? It's affected by the market. How so? So take another step deeper in there. You're right. It is affected by the market.
It changes over time in the markets.
Why? The coupon rate changes over time?
No, the interest rate changes over time before the actions the coupon rates.
All right. So let's say this is a 5-year bond. And here we are in 2015, and the 5-year bond goes in between here. 1, 2, 3, 4, 5. Put it in this terms, how is the interest rate on the bond going to change over time?
Because the price of the bond will change.
Okay, why does the price of the bond change?
Because the market rates change.
Yes. So there's something, okay, so let me put it to you this way. If I buy this bond from Obama and I hold it the whole time, what did I earn on my money? What was my rate of return on my investment? 10%. So if one person buys it and holds it the whole time, it's 10%. Now, talk to me about this market thing. What happens in year 2 that would cause the rate of return of this bond for the next person who holds it to be different? Katie? Inflation, not, we can just stick in, for this exercise, we can just stick in nominal terms. So we can ignore inflation for now. That's not what's driving this result directly.
So when purchasing the bond is it purchased on the bond and open market price to get it up or down?
Yeah, why? So let's say year 2, I choose to sell. I was the original purchaser. Russ goes to Wall Street, calls up his broker, says, hey, I want to sell. What determines what I sell? Okay. Or what type of instrument? Close, similar risk bond that I'm looking at. What type of maturity? Chelsea? No, not a 5-year, but same, the maturity, the 3-year. Yes, that's the relative instrument, right? So if Obama is now reissuing new money, one of those instruments is now a 3-year bond. Which one are they going to pick? Mine that I brought to Wall Street that was a 5-year with 3 years left, or a brand new sparkly one from Obama that's a 3-year? How is this between the two instruments? Are these different? No. No extra risk on the person. So what would you predict as young budding economists or econ thinking people if the sale of my bond in year 2 versus the sale of a brand new sparkly shiny 3-year bond from Obama, does the investor care which one they buy? So which one would they pick if the prices were different? Which one would they pick? My bond that has 3 years remaining, or the brand new shiny sparkly one from Obama? If the prices were different of the two, which one would they pick? The lower one, right? They'd buy the cheapest one because the risk is exactly the same. So our prediction as economists would be that these two things are going to be equally priced. Right? The market's going to drive. The market's not going to perceive a difference between a 5-year bond with 3 years left or a brand new shiny sparkly 3-year bond. Those two instruments are basically the same in terms of risk and everything else. So the price of those two bonds is going to be the same and determined by the market conditions in year 2. Now there might have been a terrorist attack, there might have been a new war that came around, there might have been something else. And so interest rates have fallen from, they used to be 10%, now they're 5%. Does that make my bond more desirable or less desirable? More. So it drives up the price to the point where they're going to be equalized. All right, so the price of the bond is determined by things that go on in the market and all of these other variables that are relevant to that financial instrument at the time. Okay, so back to here. So here's the price of the corporate bond. On a graph to the right of this, I should have told you we needed to leave a little bit more room. I just want you to draw a graph that has a supply and demand curve, it doesn't matter the slopes, that are intersecting at the same. This is going to be the quantity of government bonds. So it's the quantity of treasury bonds, so we're going to put a superscript T. And just for modeling purposes to think about how default risk works, let's say that initially they're priced the same. So the price of the corporate bond and the price of the treasury bond are the same. And the reason that they're the same is I'm just going to assume that there is no default risk on the corporate bond. So this is kind of make-believe time like we do with economic models here. So step number 1, assume no default risk. Or let's just say no risk. Well, let's say no default risk. Assume no default risk with corporate bond. If we now say that there's risk, which is the same way maybe they got more risky or whatever. So now let's say that there's an increase in risk of the corporate bond. What's the reaction in the markets to there being more risk with the corporate bond? What's going to be our prediction on prices of our financial instruments in the market? They're going to go cheaper, right? So the price of the bonds, so there's going to be a decrease in demand of the corporate bonds, right? So we were holding constant the level of risk. One of our demand shifters for the bond market over here is going to be this risk factor. And so D2 will locate itself somewhere to the left of where our initial demand curve was, drive down the price of corporate bonds. Anything happen over here? Does anything happen over here if we just increase the risk of corporate bonds? So there's an increase in the risk of corporate bonds. Does that stay constant?
Might have a few people have an increase in demand for government bonds since they're still trying to find money.
Right. So there's going to be some sort of substitution effect going on, right? So they're reducing their holdings of corporate bonds, and that's going to tend to increase the demand of government bonds. So there's in the portfolio theory, we've got this substitution going on where I want to put my money someplace. It's the relative riskiness of each instrument that ends up being the thing that moves demand. So over here, we've got the demand for treasuries kicking up to D2, causing prices of treasuries to go up and quantity of treasuries to also go up. As the price goes up, what happens to interest rates? They go down, right? We got that inverse relationship to kind of burn into your head of the price of bonds and the interest rates moving in opposite directions. By definition is what we learned before. If we look at the calculation of the price of the bond, what is that thing going to actually sell for? It's the discounted sum, so a present value calculation, the present value of the bond, what is it worth today, is the future value discounted by the interest rates. Now we got a little more sophisticated depending on the details, but we're going to take that future value in time period n, if that's 5 years down the road or 3 years down the road or whatever, and so now we see this inverse relationship. If I goes up, prices go down because it's in the denominator over here. So we see that in a number of different formulas that gives us the result that the price of bonds and interest rates are inversely related. One goes up, the other goes down, and vice versa. So, go ahead.
So by this model, we're also saying that the interest rates on corporate bonds and government bonds are inversely related.
Yes, I mean that's kind of what we're starting to see here. So as the price of government bonds, treasuries go up, what happens to their rate of return? That goes down. Over here with corporate bonds, their prices have downward pressure because of the risk. What happens to the rate of return? It goes up. You got it. And that is the risk premium. Back to this definition. We're tying it back to not prices, which is modeled here on the vertical axis. We're tying that back to interest rates. That interest rate differential is the risk premium, the spread between the interest rate on bonds with default risk and interest rates with the treasury bills.
So why then on the graph that you showed us earlier, do they still move together?
Oh, and we're gonna talk more about that, but on that graph, which I'm gonna pull down here in a second, but before I do, get this in your notes. This price here and this price here have an interest rate associated with them, right? And so that differential is really the risk premium. So back to that graph over there, maybe without me pulling it down, does anybody remember what it looked like over time? Which one was lower, which one was higher? Corporate bonds were higher, government bonds were lower, right? And so that's the result. That's this result that we're seeing over that, what was it, 50, 60 years? It was a long time frame. They moved together, but corporate bonds remained at higher interest rates than government bonds. Okay. Anything else there? So how do we get an idea of how risky a company is? So if I'm looking at the amount of risk premium, how do I start to get an idea if I should buy a GM bond or a Ford bond? Let's take two motor companies. I mean, which one should I buy, Ford or GM? Or would it be better to go buy Apple if they've got some bond offerings, or Best Buy? I've now named, what, 4 companies out of how many that are publicly traded? A lot, right? Thousands of publicly traded companies that might be offering bonds, corporate bonds. How do we get a feel for the value difference? Because now we could do a similar graph for the risk premium on Apple versus GM or versus Best Buy. How do we do that? Okay. Credit rating is the one I want to do. So on your own, you could look at their financials, do your homework, do your research, and hope if you're a big enough guru and you have enough time, you might be able to put all that together. What Wall Street and other investors rely on are these independent people who do that for us, these rating industries that go back. So we got Moody's and Standard & Poor's and Fitch are the 3 that are mentioned in the book. And so they go in, and what do they do for different companies? They rate them. How do they rate them? Have you seen that? I think we've talked about this a little bit in other classes, but AAA, B, yeah, BAA. The BAA thing is the way Moody's does it, and then the other Standard & Poor's does it triple B. That means the same in terms of the classes, so you kind of can compare them. So they hopefully do their research. They understand those underlying fundamentals. They have experts that just spend their whole day, 8 hours a day, 40 hours a week, sometimes 50, completely researching thoroughly the perceived risk, or the actual, hopefully the expected risk of these companies doing this, right? And so then they put it into their formulas and they have them rated. So what's the benefit of a company getting rated triple B versus triple A?
Triple B has a much higher interest rate.
Okay, so the company will be paying out a higher interest rate, right? So there's incentive for the company to have strong financials, which would allow them to borrow at a lower rate, because the bond is ultimately just borrowing, right? This is just the CEO of GM doing the love that person instead of a bond. It's just a financial instrument for borrowing. So the more healthy they are, the higher the rating agencies will rank them, and the lower rate they'll have to pay their bondholders for their borrowing. All right, anything below triple B is considered junk, even though it might not be too junk. So Michael, what's his last name? Oh, this is not in your book, but he kind of made the junk bond market famous back in the 80s. He was actually a pretty brilliant financial guru that just got himself in a heap of trouble because he wasn't completely honest, but he was a pretty sharp guy. And he popularized what was known to become the junk bond market. And so it's just trading companies that aren't rated at that triple B or triple A level. And so they went through, and the different rating agencies will still put ratings on those, and there's a marketplace for people willing to trade in those markets. But they do not call them investment grade material. So it's that's why they loosely referred to as junk, but in reality it's just companies that aren't as financially strong. Your investment might be pretty good, you might still have a fairly low probability of default, but it's still there. And so it's not good enough to be a commodity good like the AAA and the triple Bs, where you're just pretty rock solid, that you don't have to worry about default risk for the most part. You're paying that little bit of a premium, but not too big of a premium over what the government gives out. Okay, any questions or comments there? Okay, so these next two kind of fall in a similar vein to what we just did with the default risk. So liquidity means what? What is liquidity? Okay, how easy it is to sell the asset that you're holding. So your car isn't real liquid. Even if you think it's worth $5,500, it might take you a little bit of time to market it and get it sold, right? So if it takes you a week or a month to get what you perceive to be the fair value, of course we know that's sometimes nebulous, it's just not real liquid. You can't, if you value it, even if the Kelley Blue Book value is $5,500, doesn't mean that tomorrow you can just get $5,500 in your hand, right? So your liquidity is the ability to convert something into cash. And there are some small liquidity differences with these bonds as well. Corporate bonds tend to be less liquid than the government bonds. Now, you start getting into the AAA bonds, they're pretty liquid. So the liquidity premium would be very small. All of this is going to, default risk and liquidity issues are going to fall into this risk premium calculation. This is just another element of it. This one plays a bigger role than this one. But the ability to turn it into cash, so as we start to get less and less liquid, there's maybe less and less people willing to buy that particular corporate bond. It might take a little bit to unload it. Or if you're holding a large share of it, if you own $1 million worth of that company, you bring that to Wall Street, and that's a lot to unload at once. You might need to kind of milk it off a few days at a time before you just dump that large volume of that particular company's stock. If it's a little bit lower on the rating scale, the liquidity isn't quite there for you to convert it into cash very easily. So liquidity plays a role in this. And then the graph is going to look very similar. If something's less liquid, less demand, lower price, higher price here, all plays into the same story of creating that risk premium. So it's just another factor in the risk premium. Okay, comments, questions on liquidity? All right, and our last one is tax considerations. So John brought up the government bond thing, and you were partially right, but it's not the federal bonds. So they they changed the law after, I think it was World War II, and wanted to give some preferential treatment for municipalities to be able to raise money. And so municipal bonds are exempt from federal income tax. So under tax considerations, let's do this here. I guess I'll call it number 3. So, municipal bonds are exempt from federal income tax. Now, some of that tax risk, just as in an indirect way, could affect your default risk. So if the government comes down with you on raising your taxes and that puts you out of business, that could increase your default risk. So tax considerations are kind of indirectly factored into those as well. But here, very directly in the fact that it's exempt from the federal tax. All right, so example. Suppose we've got suppose we've got the price of a municipal bond at $1,000 with a coupon payment of $80. And we've got a Treasury, U.S. Treasury bond that's priced at $1,000 and a coupon payment of $100, sorry. If you have a marginal tax rate, little t, equal to 30%, which one is a better deal? The municipal bond. Okay, and why?
It's tax free, so you get all the 80. The other one, you lose $30 payment because of the tax rate.
Right. So the coupon payment ends up being your income in a given year. You're going to have to claim $100 to Uncle Sam on your tax return, which means Uncle Sam's going to grab 30% of that number, and you're going to be left with $70 after tax. So after tax, the municipal bond holding risk constant. Now have municipalities defaulted? Yes. So now we've got contributing factors. Again, less likely, but lots of examples of those defaulting, by the way. So even prior to Detroit, there's Orange County, California, and other places where there's been defaults on municipal bonds. So that's factored into the pricing, similar to what we're doing here. That whatever that price ends up being, there's some default risk with that. But and also another thing I wanted to point out: does everybody fall into the 30% tax bracket? No. So it totally depends on your situation, whether muni bonds, as they're affectionately known, whether munis are a good place to park your money or not. It depends on what your actual tax situation is. So let me write over here your after-tax return. With the municipal bond, your after-tax return is your payment equals $80, or your funds. You receive $80, with the federal one, you received 100 minus 30 equals 70, giving you an effective after-tax return of 8% on the muni bond and 7% on the treasury bill, treasury certificate. If the default probability got higher and higher and higher with cities, what would tend to happen to this green line versus the gray line? It would go higher, right? So that's the balancing act that's going on. So what we see here is that, for the most part, the market has perceived muni bonds to not have a default risk that's too high so that it overwhelms the tax effect. And that what that causes to happen is that the interest rate on the municipal bonds ends up being lower than the federal bonds, which then corresponds to the prices. All right, let's call it a day there.